Brian Bushnell was also one of our speakers in Luxembourg at the banking scene, and he mentioned also that trust in banking is currently under pressure. Now, Brian, could you elaborate a bit more on why that is?
Banks have, for a very long time, they were built for stability. They were built to do one or two things very well. They were heavily regulated, so they didn't have a lot of competition coming after them to provide services. Mm-hmm. Now that's changed with regulation emerging, with technology changes in customer behavior. Right. You see many other parties coming in to offer similar services and claiming a share of trust from the customer. Now banks were built to be reliable, stable workhorses. They weren't built to be flexible, adaptable, or agile. So when new customers or new entities come along to offer great customer experience, new products and services, and all in a digital way, 24 hours a day, banks have a great deal of trouble to adapt and to provide something of a similar level of quality and service. They simply become less relevant. Mm-hmm. Now, these days, when the less relevant you are, the more grip you lose on the customer, right. And that in turn, over time, has a negative impact on the perception of trust towards the institution.
Now, the essence of your presentation was also how mutualization of financial services, or the back end of financial services, could help banks to increase the trust customers have in them. Could you explain that a bit?
We're at a point in time where, of course, not every bank can, for financial reasons, for technology reasons, can afford to do all of the things they used to do. They can't provide all of the services to all of their customers in the way they used to. Mm-hmm. It's very costly, very complex, and a lot of those activities that they do in the back end they're commodities. They're simply done very similar by every single bank in the industry. You talk about compliance, AML, KYC, you talk many payments activities. They're all pretty much the same at their core. So the banks, one way they have to retain the trust or retain the relevance of the customer is to say, well, we can do this together with other peers in the industry, other regulated entities, can work together to provide something much in the way that the cards networks have done in the past. They provided something over time at a global level that inherently brought trust among the actors. Mm-hmm. Who interact with it, to the point where any customer today goes to a card network and says, this card, I trust it to work. Yep. The same can be with mutualized services, top of the list being KYC, instant payments, PSD2 compliance, number of other things, mobile wallets. A lot of things can be done to work together, and by pooling together with other regulated entities, you can compound the trust in the eyes of the customer as well, that these are banks, they are solid institutions. When you're dealing with the infrastructure layer of the financial services industry, these are the ones that should be efficient, but at the same time, solid and stable and reliable, and managed in a financially responsible way.
And I guess an additional reason for mutualizing services is also that bigger data, more data creates better conclusions.
Absolutely. The richer the data set that you get certainly allows you to make better decisions, certainly in the credit credit process. Mm-hmm. On the other hand, it also allows you to generate insights to what your customers are really doing, and possibly generating new products and services over time that allow you to serve your customers still better. So it is a way for banks to remain more relevant, and over time, by doing something competently and maybe very effectively, it shows that they can earn and retain the trust of the customer.
Right. Thank you very much, Brian, and I hope to see you again in March in Amsterdam or in May in Brussels.
Thank you.